Welcome to Advanced Course Part 5, Moving Averages. All right, if you're enjoying the content so far and haven't subscribed, go ahead and do so. If you want to support what I do and donate, you can find those details in the description below. And if you haven't checked out my Twitter or TradingView account, I would suggest you do so as I post up charts, content, release schedule, and so forth on there. All right, without further ado, welcome to Moving Averages. All right, what is a moving average? Moving averages were first created back in 1901. I can't remember exactly who created them. Maybe Gould created them. Memory slips away from me. Regardless, moving averages are something that have been around for 100 plus years. It was originally created as the smoothing of data over time, right? It was a number and it was a equation that was said to have given you an average over a course of time. So immediately it's starting to dissect a moving average. Well, what is a moving average? Moving average is a measurement of time, right? So if you have a number, let's call it 10, and you are using the number of 5, and you continuously use that number of 5, the effect of time will bring your average down to 9, and then to 8, and then to 7, and then to 6, and over a course of time, a certain criteria, that average gets smoothed out over time and it reduces. So really, it's important to understand that a moving average is it's the effect of time. So time has a direct correlation with moving averages. People see moving averages and they just kind of tend to tunnel vision themselves into seeing on a chart. Well, let's go to a chart for a second here. They tend to see on a chart something like this, where you have one line like this coming and crossing another line like this, right? And they tend to focus on one thing only, which is this point right here, which is that event of a moving average crossing, right? So people kind of have this tunnel vision idea and they don't understand what's happening in this right here, right? They don't understand what's happening from this point and this point and what this average means versus what this average means, right? And really, it's the information in between that's important for moving averages, right? This space in between is the effect of time, right? This top line is affected over time. It is affected just like this bottom line is affected over time. So really the idea of moving averages is the cause and effect of time, right? What does time do for any stock, any average, any course of events that could happen, right? So one event creates another, right? The event is created from time averaging of space versus time, right? So it's kind of a bit of a complex thing to think about, right? Well, we have this equation of time, and you can go into this mathematical breakdown of what time is, and you can create a calculator for it, and you can, and I've seen it, there's plenty of systems out there and strategies and for sale techniques that have, and let's go to this for a second. Let's go to the chart, and they say that this effect here is worth 2 points, and then this effect here is worth 1 point, and then this effect here is worth 3 points, right? And they have this equation and this formula that they break down, and it creates a system as you would have it, which is completely ambiguous to really what moving averages mean, right? So you know, what is the event of averaging of space versus time, right? It's a concept you kind of have to kind of think about and grasp your mind around, which we'll break into a little further in this lesson. But just to start to think that one event creates another event, right? And in between there you have the averaging of space versus time, right? So the space between moving averages versus time and how that time affects that space. So the first thing we're going to talk about is what's called the mechanical. A mechanical is exactly what we were just mentioning. A mechanical is a common use term in the industry that has been created based on things like RSI, moving average, these indicators that really don't do anything and they don't mean anything at all in the space. They really are just systems that people have created, right? So an idea or an example of a mechanical would look something like this. Trader X creates a system, and that system says that if you have plus 6 points, okay, and you guys may or may not have seen traders out there doing this. I know I have, I'm sure you guys have too. Once you reach plus 6 points, you are going to purchase a stock, right? You are going to purchase. We're just going to put PUR for purchase. So once you reach plus 6 points, you're going to purchase, and therefore you're going to go here. And at that point, you're going to sell at 10. This is a mechanical strategy. This is highly flawed thinking. And we're going to get into why. And this is highly flawed logic. And this is kind of the way that people use moving averages, but it's a pretty unrealistic and flawed way of doing things. And where do you get this plus 6? You get this plus 6 something like this. And I'm just going to unhide some moving averages here, and this may equal okay, let's do this. So the yellow line crossing down may equal plus 1 point because it just gained whatever, and then this yellow line crossing over 2 moving averages might equal plus 3 points, and then you're at 4 points. And then if you go to an hourly chart, whoa, that's pretty bad. Maybe at that same event right here you had a crossing over, or right here you had a crossing over, and on a different time frame that ended up being another plus 2 points, right? So whoa, that's a funny way to see things. Let's go back to the 4 hour. Maybe that'll be better. There we go. So you know, you have 1 point plus 3 points plus maybe a 2 point event here, right? Plus 2 points equals time to buy, and then it does this thing and fails and goes down, and then you end up breaking out and you know, losing some funds because you ended up taking this position where you totaled all those things equal plus 6, and then you were told to buy because you were using what's called a mechanical trade. So mechanical trades are systems that are and it's important to define this for actually why moving averages, right? There's a reason why we're defining this right now for the at the beginning of the lesson, because it then further gets into what it creates and the different things. So this idea of mechanical trading uses these point systems based on moving averages, right? And if we actually zoom in here and start to dissect this thing, which we're going to do a little later, these moving averages, if you were to, let's zoom this in, and I'm using theta today because theta recently went through a pretty big move up. So you know, what were the events leading up to that beforehand? Why did theta take this huge move up, right? So we're going to kind of get into that, and that's why I kind of chose theta for this one. And you're going to come in here and you're going to see a 15-minute chart. And in the moment, you know, you're going to see stuff like this happen all the time. You're going to see stuff like this. Oh, the 15-minute just crossed here and it just crossed here. So I should be buying, right? And either I'm buying here. Let's clear this up. And either I'm going to be buying here. Maybe let's use red for this. The green's a little hard to see. Maybe I'm buying here. Red, oh, red's just as hard to see. What would be a good color for this? Blue's not going to be easy to see. Okay, you know what, we'll just stick with green. You guys will figure it out. You guys can hopefully see this okay. So maybe you bought here because you saw it crossing at this point, or maybe you bought here because you said, oh wow, look at this. Moving average crossed, another moving average crossed. You know, we're moving up, but really then this move moves down and you got stopped out or something happened. When really the idea of entering this trade would have been pretty simple, and it would have been an event caused in the past, right? And it would have been an event like this. So you have valley that's created here, or sorry, I should say peak, right? Classic TA, you have the ending of a downtrend, which is the top of a valley, which is also the bottom of a peak, right? So you have a trend start, trend ends up doing the thing that it always does, right? Trend comes up, bounces off, first rejection 90% of the time, or 95 or whatever it is, comes back again, holds this price. When it holds this price right here, right, you know that it's going to move up. So what does it do? It moves up. Okay, comes back down over here and does the same thing and holds this valley. You notice that it touches down, it tries to break down, and it continuously holds the bottom of this trend line, right? So it continuously holds the bottom of that trend line, and then it moves up, right? So actually proper entry on this, proper entry on theta at this point in time, whenever this was, December 18th, that's somewhere between 9 and let's call it 11:30, somewhere in this area. Proper entry would have been when you're holding trend and you're closing above it over and over and over, because what does this look like? This looks like an accumulation zone, right? So this would have been proper entry. Well, what would have happened if you would have entered based on a moving average? You would have entered late. When you enter any trade late, couple things are happening. One, you're increasing risk. When you enter at a higher price, you are accepting an increased risk. So you are knowingly saying that I am entering this at a higher price than what I could have got onto before. Because the reason that happens is, I want you guys to think about this for a second. If this yellow line right here, which is a 7-day moving average, if this yellow line is to cross this 25-day moving average, a moving average cannot do this. It cannot do that, right? There's no magic there's no magic way that moving averages somehow show you a hidden entry or somehow show you the perfect time to enter. This purple line, let's take away the 99-day. This purple line at this point down here could not have spiked like that, because it's a number that is being used, an average that is being used over 25 days. So this 7-day moving average can easier come up and break through like that, because it's an average of 7 days. So its formula is based on a smaller sample, as opposed to a 25-day, which cannot come and do the opposite. So only one of these moving averages can do this event. Therefore, there has to be something that creates that spike in price, okay? So stay with me here. If this is to happen, there must be an event prior to that moving average crossing, something above. There must be an event prior that raises the price so that a smaller sampled moving average can break up and through a larger moving average, because a larger moving average cannot, conversely, you have the 7-day, and we're going to mimic this pattern like this for this, right? Conversely, you cannot have a 7-day moving average that does this, right, and scoops back up. You cannot have a 25-day moving average that's coming like this, and then all of a sudden it immediately spikes down. It won't work. It's mathematically impossible, because the averages don't work like that. So why is this important? Now let's go back to the race. Okay, so you guys understand what a mechanical entry is. Mechanical is a trading strategy that is used, it is the broad term for a trading strategy, right? It is the broad term that people use that say, I have created a strategy and I am going to use this same strategy over and over and over and over. Whether it's every time my cat meows 3 times, I enter the 4th trade on my screen. Technically, that would be the definition of a mechanical, because you have a series of events that happens and then you have an outcome that is pre-planned. So now we're not trading based on cats meowing. I would have to take a lot of trades. My cats never shut up. So we're definitely not doing a cat mechanical trading. But the idea is that it is a set of criteria that triggers a purchase or a sell order. And people use that idea of a mechanical trade to justify a moving average strategy, which is highly flawed. So to define the mechanical, we now need to go into what is called the race. And this is just something I call it. So this is what happens, right? What happens when moving averages cross? So this thing right here that happens, let's turn on this one again. This event that happens right here when this crosses here. This event that happens right here when this crosses. This event when this 25 crosses the 99. These, and this is very important to understand. Moving averages don't dictate price. They dictate interest. So you have price is this, or you have I, which is interest. So a moving average does not dictate price. A moving average will not tell you that price is going to go up. It will dictate interest, okay? Now, interest meaning that, look at right here. And this is where the logic gets flawed between people, because they just see it in a very tunnel visioned way. Is if a moving average is crossing down, it's dumping. If a moving average is crossing up, it's pumping, which is flawed, because that's not what it is, right? It's creating what's called interest. So when you have something like this happen, it is creating buying interest. When you have something like this happening, it is creating buying or selling. Sorry, I shouldn't have said buying interest. It is creating volume interest is the better way to put it, right? When you have something, and let's get rid of all this stuff on the screen here. When you have something like this, it creates interest like this, interest like this, interest, right? That is what moving averages do? They create interest in stock, right? And going back to this chart, you need to understand that before we get into why what is called the race, okay? So this is the next thing that happens in moving averages. The race happens. And what is the race? The race is the interest that's created, almost like the race to get into the stock, or the race to sell, or the race to see what's happening. So let's look at this thing here, right? We have a point right here where this has created interest, right? This creates the race. People see this moving average cross, all of a sudden you have an increase of buying pressure because people see this as a time to buy, when really it's just a point of interest. Because oftentimes you will see something like this. Well, wouldn't this dictate that our price is going down because we came down here, we touched, and it looks like we're going to break this? Wouldn't this look like our price is coming down and about to break? No, it's creating interest, right? It is creating a point of either buying or selling interest, right? And if we keep going further, wouldn't this dictate that price is going to rocket up? Well, if you are just trading based on mechanical entries and systems and moving average point systems, then yes. And wouldn't this indicate that it's about to break up again? And wouldn't this indicate it's about to break up? And wouldn't this curve up here indicate it's about to break up, right? And wouldn't this curve right here indicate it's about to break up? So all these moving averages are doing is creating points of interest. So every time you have a moving average cross, you'll see a direction of movement, either up or down, right? And the occasional time you'll see accumulation or distribution patterns, right? Where are we here? Okay, what's going on? Chart's frozen. Gotta reset it. Oh no, it's not. Is it? No, it's not. We were right here in the move. Okay, let's back up before, actually, because I wanted to look at this before all this price action happened. I wanted to look at the events leading up to it. So actually I went a little too far, but that's okay. We can just come back here. So if you were to look at before price action happened, was there any crossing of levels here that was really indicative that this was going to take a 400% move? Or what was this, 1200 to 4000 or whatever it was? So that was a 200-300% some odd move. Is there any indication that when we are sitting here, like, what is the difference of this event here when you have a moving average higher up here and this moving average together, right? What is the difference between this, right, when you have this failure to break above? The difference is moving averages don't dictate moves, right? They do what's called the interest, and they create what's called the race, okay? So if you were to simply take the idea of start of a trend, right? Trend start would be this one right here. Now let's draw a level. Levels here. Level holds, price moves up, right? Same thing. So what happens in the race? The race is this. The race is the interest that the market creates based on moving averages. So you have all these different things out there. You have exchanges that use moving averages. You know, look at how many times this thing goes up and over, up and over, up and over, up, down, up, down, up, down, right? Look at here. You have a double cross on the 15-minute, right? Shouldn't this thing just skyrocket at that point? Well, what happened here? You have a double cross on the 15-minute, right? Shouldn't that thing skyrocket? You have the 25 crossing over, just like the 25 crossed over here. But what happens, right, is the market has an interest that's created. So this is where the race gets created, right? This thing right here, the race. And this is what the race is. The race is this. It is the exchange data. So we're going to call this EX. It is all the indicators out there, right? It is the indicators, IND. It is the people staring at charts all day looking for some kind of entry signal like this, where they think that, oh, moving average crossed, it crossed again. Okay, let's enter. When in reality, right? And just because I'm going to keep doing this whole time, we have an uptrend that starts here. Uptrend was lost here, right? We come down, we dump. Shouldn't this have been the insane pinnacle entry, right? We were sitting here trying to break this moving average, and we did this dance, and then all of a sudden, boom, we broke this entry here. And what happened here? Well, there was a failure of a move because it actually didn't manage holding the trend that it created on the uptrend. So this is what happens: is you have exchanges, they have data that they show the industry, you have indicators, you have people who look at, so we're going to put people right in there as well. People. Oops, well, this is pretty sloppy. I probably should have used the text tool. I don't know why I didn't, but that's okay. We have exchanges, we have indicators, we have people, we have strategies like mechanicals, right? We have strategies, we have mechanicals, and we have all these different things that are saying, let's enter. And maybe, let's just delete this. Oh, okay, that's fine. Yeah, because I'm very anal, I'm going to sit here and delete them all before we continue. It's just my process. Hate me if you want, but that's okay. Right, so what happens is maybe the indicators start signaling here, and then maybe people start saying, oh, look, we just crossed a 7-day crossing at 25, and we're about to cross a 99-day moving average. Then you have the people coming in, and the exchange data is funneling all this information here, right? The exchange is funneling all this information into this point right here, right? And then you have the indicators telling you to buy because you are seeing the crossing of some level, right? And then you have mechanical setups and signals going out there in the industry, and people are saying buy, 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 right? But really what they're missing is the entry. So if you have, and this is going to be the top of the move, and this is going to be the bottom of the move, okay? And we're going to rate this as a 10 and this as a 1, just for simplicity, okay? So you guys understand, if you have 10, which is up here, right? And you have 1, which is down here, we're going to put that arrow up, 1. And this is the graph, right? This is the scale. It's like this, right? That's the scale of 1 to 10. And if perfect entry was 1, it would have been the start of an uptrend. So maybe the exchange data, people see this here. So what does that end up being? You're entering at this level right here. And then you have people who have noticed that, hey, this thing is crossing the 99 days. So maybe those people are entering there. And then you have the people who are seeing this move start to develop, and then they go and do this. And they go into and I want to check the date here, the 29th on the right around, what is 2300? Okay, so then we go to the 1 hour chart, right? And this is where it starts to get really, really funny. So where were we at? The 23rd, right? And this is where it gets really funny. We're right here, and they say, oh my God, look at the 15-minute just crossed. Everybody's buying. We're about to go up, right? Look at what's happening, guys. Let's wait for the retracement, which happens right there, right? Let's wait for the retracement and go long here because we're just gonna go off. And then you have those people entering up here, and then you go to this, and you go to the 4 hour chart for the people who are really late to the game, right? And where's the 19th here? Oops. Oh God. There we go. And then you have these people entering the trade, and they notice something else, and they say, and they're entering the trade right in around here, and they say, oh my God, look at, we're just about to find support on this level, right? Oh my God, the moving average is acting as support. We better enter. And then if we go back to the 15-minute chart, and then they find these reasons to justify these entries, right? When really all the moving average does is create a point of interest, right? So then they have people entering up here. And then what is happening? Okay, so let's take a look at this move, right? You have a downtrend that's right here, okay? So let's mark out the downtrends. Let's leave this data up. So you have a downtrend that starts here, right? And then you have your next downtrend that is starting right here, right? That's the next downtrend. Look what just happened. Let's zoom in. Make sure magnet tool is exact, right? Has this downtrend been tested? Well, technically this isn't a test, so no, it hasn't been tested, so it's going to reject. Well, look what just happened. People entered this trade based on the moving average when the downtrend hasn't been tested, and then you have all the people who entered at 1 or 2. You have all the people who entered at 1 or 2 down here. Good old magnet tool, you know, the ongoing joke. Let's to do with the cotton candy one more time. Yeah, it's make the line squiggly, frustrate them. So you have the people who have entered down here in this move who know that the downtrend needs to be tested, and they've had the time to plot this move out. So we have a 15-minute chart. So if we entered here because something else was held, right? This trend was held here, or for whatever reason, here's the start of the uptrend right here. Back. So if we were to mark this, here's the start of the uptrend right here. This is it right here, right? So this uptrend was held, and then this uptrend was created. And even if you were to delete this and you were to say, okay, even perfect entry happened, let's go even further back, and this is the start of this uptrend, right? If this is the start of the uptrend, this level was held here, so this ends up being accumulation before the move up. They already know. So the people who are entering back here, right? Anybody in this move who's entering accumulation, refusing to let this price go down, they already know where their target is. They already know that they need to test the smart trader already knows, and the smart trader is buying right there. The smart trader already knows you need to test this downtrend because it's going to reject. It hasn't been tested yet. There's like a 90 to 95% chance it's going to be rejected, right? So what's going to happen is they already know this is the exit, and you have a bulk of people entering in this zone, maybe that 5 to 10 ratio area, right? If we go back to this, my beautiful 1 to 10 art, you have all these people who have entered the top half of this. I got to get rid of this. This thing is terrible. You have all the people who have entered that trade between that 5 and 10 level, that mark, because a moving average told them to enter there, because things were about to break out, right? Because things were about to bust into the stratosphere, and we were about to forget mooning. We're about to go to Jupiter, right? You know, this is about to be Hulk Hogan and Randy Savage going to the stratosphere, for those of you who know that old school reference. I hope some of you do, and I'm not coming across as the old crazy old man who just is talking gibberish and paraphrasing things. So anyways, you have these you have these traders who have already identified a distribution zone, which is right here. Meanwhile, you have people buying up into this. So that is called the race. The race ends up being how many people start, and the race is very relatable, because in the end, what is the race? The race is FOMO, right? It's people are seeing this thing move up, and they justify reasons as to why this thing is about to moon, and they say, oh, guys, man, that 12 hours crossing into the daily, and we're ready to rip and roll, right? And it just becomes such a flawed way of thinking, because a moving average, even to the base idea of a moving average, going back to the very beginning of this, you have something that happens, and we're gonna remove these drawing tools here. You have something that happens. You have one average with another one that's coming through, right? And you have all this space in between. So just going back to the idea of the logic of this moving average, it's not the crossing of these moving averages that make a difference, right? It's the time and space and the things we see before it. Because if you're just trading the moving averages, all you're doing is trading into someone else, and all you're doing is what's doing called entering the race. And the race is just late entry, which is increased risk. And increased risk is just taking a worse position and making your stop outs much worse. So if you have to stop out quicker, you're losing the potential in the trade, and you're risking more leverage in these trades to even take a position. So understanding the race and what happens before the race, right? What is that event that happens before the race? So if we look at this right here, what happens before the race? What's the event leading up to the race? And that's where that idea of moving averages, right? It's the idea of space versus time, right? The space that gets created versus time. This is only used, this right here is only used to say, oh, look, there's interest being generated, okay? So when someone is buying this level down here, right, and that space is collapsing, people know, right? Your smart traders will know that as this space collapses, you are going to have more interest in this stock, right? You're going to have more interest. So really, what does that make? What does that become? That becomes the signals that go out in the industry. That becomes the exchange lines that cross over, and people start buying them because all of a sudden there's a justification for something that's going to moon. It becomes everybody who enters a trade too late to fully see the real potential of the trade, right? And then over half those people, as they're entering the trade, they're just getting sold into. They're just getting sold into, and then the price does this and goes down. And it's not because moving averages failed. It's not because, something like whatever news article or something that happens. It's not because of that. It's because of the charts and what's being told into it. You had an untested downtrend level, right? You had an untested downtrend. Oops, you had an untested downtrend level back here, right here. So that this was bound to reject on the first touch, which is right there. So this has nothing to do, and you have an uptrend that was held here. So this has nothing to do with moving averages crossing, and all of a sudden it gains strength, and all of a sudden it gains this room to move. It has nothing to do with that. Had this been set up already, right, then look what happens here in theta. This downtrend was already tested, so it's not rejecting there. This downtrend was not tested, but for other reasons, the move continued up further than that, right? And it's fractal. This 15-minute chart is fractal, right? On the daily, what happened? Oh boy, here we go. Good old theta. Right? It's fractal to the daily charts, right? You have a downtrend that starts obviously right here, right? So let's mark this out. You have a large downtrend that starts here, and that gets tested. So it was already tested right here. So this can come up and test the next downtrend level, which would have been right here, right? And then here, and then so forth. And it's probably fractal to the weekly, right? You have a downtrend here, you have one here, you have one here. So these are the levels that are being tested, right? It's all fractal. So understand that moving averages create what's called the race. They create interest in the markets. They create points where you're going to see an increase. And that is the key takeaway for moving averages. They are not points where you're going to dump price or points where you're going to climb price. They are creating points of interest, and you'll see it in charts all the time, and you will have been in these trades all your life. And let's delete these drawing tools. You will have been in trades all your life, and you'll do this just like everybody does, and you'll say, okay, look it, we're starting to stabilize on price. We've entered accumulation. If you understand accumulation and distribution theory, this is coming down on top of us, right? We have a 99-day. What happened the last time we crossed over 2 moving averages and the third moving average crossed over? So not only did our 15 cross the 25 and then the 99, but then our 25 crossed the 99. So it's like the wham bam setup. And then we do this and we go, oh my God, are you kidding me? We're about to moon, let's go, right? And then what happens, right? You see this moment in time right here. 25 gets crossed by the 7 crosses the 99, the 25 crosses the 99, identical setup to this. Well, what's the difference, right? The difference is all that a moving average is doing is showing you a point of interest where price can go either up or down, or something is going to happen where there's some other reason why a level is being gained or failed, okay? So now that you guys understand kind of what the race is, I guess I could just right click, remove all drawing tools. That would be the easy way, right? And here's another good example, actually. Before we move on, let's talk about the other side of it, right? All of a sudden right here, let's take a look. We have the 25 crosses down on the 99. So theory out there in the industry would say, well, one of the bigger levels just crossed an even bigger level. We should all sell, right? Well, okay, that happens here, but then price is stabilizing right here. We've got a baseline price and this average is coming down over top. Shouldn't we be selling based on this idea? Okay, well, whatever. We come up and we break the 25. Well, okay, let's see what this move does, and we break over the 99. And at this point, we should just, even if we're going to take a little jump up, we should take this, jump up like this. Well, we don't. We actually come back down and we test back down. So really, there's no rhyme or reason to moving averages. There's no dictating logic. There's no anything that you can get out of analyzing moving averages. And look, it bounced down. Shouldn't it have come down and broke these levels here? Well, yeah, it should have, right? But it didn't. So there's really no, there's nothing you can take away from analyzing moving averages other than interest in moves, because something else is happening. Now, the next part of this. Now we'll talk about floating at the end. Actually, we'll talk about floating now. So floating is something that happens, and now that we've kind of stripped away your expectation for moving averages, we can talk about how moving averages are helpful. Floating is something that happens in all stocks, right? If the idea of floating is this: right? You have a trend there, or yeah, that's a good one. We'll draw a few trends here. You have that one there. You have this one, it looks like right here, right? So you have these trends, right? So something happens in everything, in all stocks, in all patterns and all trends. Something happens called floating, and in early lessons I referred to this as gaining the trend or stopping the bleed. When something's coming down and it has to kind of get to a point where it's found accumulation and it has to break through that, right? And the same thing here, this trend is happening here and it has to end up breaking through that in order to gain some kind of momentum, right? That's called floating. So when you have accumulation that happens, right, that holding of price that pushes through like this, right? When you have price that holds, you end up doing what's called floating the level. You actually don't have to gain any type of, and I think I've touched on this before in the course. You don't have to actually push up to break the level. All you have to do is float through it, right? So if we go to, and I know this one because I was in this trade and I watched it. I watched it happen. Oh my God. Okay, there we go. I watched it happen. BRD coin, bread coin, has a tendency to constantly take these large one-day moves up. And I was in this one, and I believe it was this right here. And what had happened here is actually it floated through a weekly level. So this is something that you can always keep an eye out for. And this is important to understand that in the grand scheme of things, in this moment right here. So what was this? November 18th. Let's go to the 4-hour chart for November 18th. In this moment when this happened, November 18th, right? And let's go like this. And where's our replay tool? Oh, my brain is collapsing. It's hidden, that's why. Let's go right here. In this moment, on the weekly chart, this coin floated the level. Right there. In this moment, it took this huge leap up because in that moment, and you will not be able to see it illustrated, but you'll be able to see somewhat of it. We're going to cut this back again, right? In this moment, what was happening here is this level was being held right here. This level right here was being held, and the weekly moving average was coming down, and it was at a point where the price was just holding right through this average. So this average came down here, right? The magnet tool's not on, it's still being funny. So this average came down here and price actually just held through that average. That is called floating. So what had happened, right? What had happened is this, at this point right there, you can see it. It held a baseline price and it floated through the level. And when it floated through the level, all it had to do was hold price. And when it floated through the level, it completely shot up. Right? And you can see how much it shot up because of the strength of a weekly level, a weekly moving average. So this is where we can start to talk about how moving averages help you, right? And it shot up and did this crazy thing, right? And it had interest. And what happened there? What caused, no, so think about that for a second. What could cause such a crazy move up when you have from 4,800 all the way to 8,900 or whatever this, yeah, 8,900. I think I sold at 8,000. Oh, I sold it at this point right here. It was, yeah, 8,079.95. So I sold right around the 8,000 mark there and I entered down here. So it was a nice trade. But what happened, right? We floated the level, and remember, if going through a moving average is going to cause interest, let's think about fractal information now. If a 15-minute level gets broken, it's going to cause your initial burst of interest and that initial race, right? It's going to cause the race. And then it's going to overflow into the hourly, right? And it's going to say, well, people are going to look at the hourly and say, well, what's happening on the hourly? Oh, well, all of a sudden we're crossing over on the hourly. So now you have even more interest being generated, right? And then what happens is it's crossing the 4-hour level and then the daily level and the weekly level. So you have to realize that just like moving average, or just like levels and finding trends and patterns, moving averages are also fractal, right? And floating through a level like this, you would expect such a large price move up to actually hold and for price to move up because this is a pretty substantial move, right? But what happens? Look at that. And then probably just ends up going down from there. Well, it takes another push up as it goes through the moving, as it floats through the weekly, and then it ends up rejecting the level. So over the course of these days that had happened from this level floating up and through, actually nothing really happened. The price actually just completely retraced, and it was just a point where you had a lot of interest being generated, and it floated the level, right? So moving through something like that, when we've seen it in trends, we've seen it in all different areas of what we do. We see it in levels, we see it in trends, we see it in wedges, we see it in peaks and valleys. When you float through something, you are going to end up losing or gaining that level. So that comes down to what we call ignition. So ignition is when you are using a moving average, and many of you know this by now already because we had talked about it. If we look at the 15-minute chart, and is it right here, this point where it went from 5,000 to it was actually earlier, this point right here where it went from 5,000 to 9,000. Yeah, it was right here. So if you start to look at and maybe I'll put a box around this here just so we can get back to it quick, and I'm gonna tone down the color of this box because it's a little bright, so we're just gonna do something like that. So if you look back to here, what is ignition? Ignition is when you have one level igniting into another, igniting into another, and igniting into another. So you have a 15-minute chart where all the levels cross, and then you notice on the hourly chart that, okay, well, if we're going to cross on the 15-minute charts, and this is kind of where you have to start to visualize what's going to happen. If you're going to cross over on the 15-minute chart, that's most likely going to raise the price, which is going to put more people in the stock because more people are going to be interested in buying it, which is now the hourly looks close, right? So an example would be if you started back here, you notice that you're starting to cross over levels here, and then you were to switch to the hourly, and on the hourly, you're about to bounce off a level, right? And it's like, okay, so we're going to bounce off this moving average, which, dictates that we should move up. And then you go to the 4-hour, right? And in that 4-hour, we actually have nothing to break. So we have actually a clear path to go straight through. And then you go to the 6-hour. And the 6-hour was just broken, so we must be mooning, right? And then we go to the 12, and that's actually going to break the 12 too now. So holy Hannah, this is starting to get to be a real move. And now the 25 is starting to come up, and the 25 is going to break the 99, and the 7-day on the 12-hour is going to break the 99, and the 25 is going to break the 99. Then we go to the daily, right? And the daily just broke, so we're about to moon and go to the stratosphere again, right? And then we go to the weekly, and we see the weekly levels floating through. So that's ignition. Ignition is when interest is being created because you have a justification of all these different events and facts, and you can say there's going to be interest created. But then really, if we break down this move from the start, what really happened in this move? Because where are people entering based on this idea of ignition, and where are people entering based on this idea of increased chart volume and increased interest, right? So let's break it down. Okay, we have the start of an uptrend here. Okay. We also have, looks like if we were to break this fractally down in the 15-minute, if we were to break this down into a lower time frame, we have this right here created some kind of pseudo trend, right? So almost like a trend within the trend. Well, it's a fractal trend, but it's on a lower time frame. So we know that if we are going to hold this level right here, we're probably going to be moving up, right? At the least, we have to do what? We have to hold the start of the downtrend. So at the least, we have to hold this level. So, and I'm going to turn these moving averages off for this because we don't need them for this. We can clear this up, right? So you have this right here that gets created. And then this would be moved to here because that was the start of the new trend. And then, fractal, this obviously moved down, and that would be the start of the trend. And then top of the trend would be right here. Okay, it would be somewhere like this right here. So you have the top of the trend. Let's put the magnet tool on, get this exact. You guys know me, I like my exacts. So let's zoom in and see what happens, right? Well, the move goes up, right? Oh, magnet tool, good old magnet tool. Move goes up, right? Has a little retrace, breaks over the top of this, which is this right here, right? That's that peak right there, comes up, creates the fractal peak, right? So the entirety of this is right here, like this. This ends up holding. Where's my paint tool? This ends up holding, right? Comes up, creates another peak right there. So you're creating uptrends within uptrends, smaller uptrends within smaller uptrends, right? This is creating this right here. So I'm going to delete that now. I'm going to delete this now. We don't need that. We don't need that. We don't need that. We don't need that. But what we do need is the next trend start. So the next trend start is here. We come up, we first touch test this right here. So we first touch test the top of this trend, which now we're going to re-add this. And you guys don't take away and re-add, but for you guys, I'm doing this to show you what happened. This then, as we talked about in the last video, becomes a tested level. And then when it comes through, it can break through that tested level, right? So you guys can see that a moving average didn't dictate this move. A moving average couldn't have told you to buy here and here and here. All it can tell you, all that moving average can tell you is that interest is being generated and it's going to move one way or another. It's either going to move up or it's going to move down based on this interest that's being generated. Or it's going to go into a thing like this. Because all in all, this whole time, right, if you guys remember, let's circle this area here. This whole time right here ends up being accumulation, right? So let's mark accumulation out and let's see how that plays in with our moving average. I'm going to zoom back in here and we're going to, yeah, we can delete that. That's fine. We don't need that. We don't need that. We don't need that. All we're really going to do is mark out accumulation, right? So let's turn our moving averages back on now. Right? If this is accumulation, right? This should make it as clear as day. If this is accumulation and you have a moving average breaking down, but you know this is accumulation based on what has happened back here, and you're losing a level, shouldn't that tell your moving average ideology that this is failing and you should sell? Well, you just sold into the smart people who are accumulating before a huge move up, right? Now let's go to the hourly. The hourly didn't tell us anything. The hourly actually just shows us that we just have some kind of move here and actually nothing happened, right? So for whatever reason, people justified this move was moving up based on moving averages. There's nothing there to show you that you should be moving up and taking this huge move up here like that, because something like that should look like this, right? Something like that should look like this, where you have an hourly level breaking up and two over, right? Breaking over every single moving average there is, but that doesn't, none of that happens here. Well, what about the 4 hour? What happens? And I'm sure maybe one of these levels will end up lining up and, you know, it'll catch me and I'll be like, oh, well, there it worked out. But okay, I thought this thing was, oh, it's right there. Aha, it's hidden. You know, maybe one of these things, you know, maybe a 6 hour or something does have one level crossing, but it's not the fractal chase to find the one crossing level, because I guarantee you, if you find one crossing up, you're going to find 4 crossing down. So it's flawed thinking, right? Well, nothing is happening here. We don't even have anything happening in here, right? So let's go to the 6 hour. We're going to go through every single one to see if we can find one that actually shows us any kind of relevant information. I already know where it is right here. There's nothing on the 6 hour dictating this large move up. There is nothing on the 6 hour dictating this large move up here. Let's try the 12 hour. It's a stretch, but you could possibly say that the 12 hour gave you signal back here to enter, and if you entered back here, then you would have guessed that it was going to cross over here and that this one was also going to scoop up and over. But as this is scooping up and over here, back on this side, you're actually losing price into this moving average going up, which says that if this 25 is, and the purple is a 25 and the 99 is the pink, if this purple is crossing above this, shouldn't this actually just be going further up more? But actually what you're doing is you're actually moving down into it. So as your moving averages are all starting to come up, your price actually starts to move down. So you could maybe convince yourself, because you won't convince me, it'll just be yourself that you have to convince on this one, that this was a point right here. This point right here on the 12 hour chart for some reason was, you know, the indication of the move happening. You know, again, you can convince yourself if you want. And it's the same thing on the daily. Like wasn't the daily breaking out right here, right? Didn't the daily break out right here? And because it came down and came back up, and didn't it break out right here, right? Didn't it come down and back up? And then, okay, it broke out here, but then it came back down here anyways. So even when this daily is crossing, it comes up and it goes here. So maybe you ended up buying on the daily because it crossed here, and you said, okay, price just broke the 25 day, right? You're in this move and you're here, and the daily all of a sudden crosses, and your price starts to go up here, and then you bought right there, and then look what happened. You got moved down into. So is that even a thing? I don't think so. The weekly, that's in there somewhere. Well, yeah, the weekly we floated through a weekly level. So we know there's going to be interest generated, but it's not because we ended up saying, okay, the moving averages are telling us what to do. All we could glean from all that information is that there was going to be a big move up, because if you have something as strong as a weekly crossing, right? If your weekly cross is going to happen, you know there's going to be a lot of interest generated. So something is going to happen. One way or another, something is going to happen. Just like right here, right? When this started to come up and touch the weekly. One way or another, something is going to happen, right? Because interest is being generated, and look what happens. And boy, does it ever happen, from 7,000 all the way down to 4,000. So if you wanted to use your moving average strategy to say that all of a sudden your weekly is being, starting to cusp up, and the same thing here, right? Your weekly just formed, and you're saying, well, my moving average is telling me that I should be buying because I'm about to cusp this level, and then same right here, right? And then same down here, right? This was just floating the level, because this is actually where two levels intersected, and one floated through, so it caused this kind of huge spike ups, and that's just synonymous with everything, right? You could draw trend lines anywhere on the map. Look, swing high to swing high. As soon as this starts to break through and floats through, you start to move up, right? Or wedge theory, where you have that ends up being a wedge like this. You have the downtrend here, and you have to the uptrend right here, right? So as soon as this breaks, right? Oh, I did that wrong. It would be the swing low. So it would be something like this, right? Something along the lines of that, right? Something along the lines of this as your descending trend, right? The magnet tool is making it a little hard to get it exact, right? And as something like that. And as you were to break through this, you're going to take a move up. It's the same thing, right? You're floating through a level, right? That's the level, and you're floating through it. So really, the whole idea of moving averages is such a flawed way of thinking. What you take away from moving average is the interest that it creates, and understanding that if you are entering a trade properly, you can then foresee a move happening. And I'm going to go to do kind of an example where I use this actually today to make it was this morning and last night as well, and it was on theta BTC, and this was something that I did. Let's just clear the chart, remove all drawing tools, go to the 15-minute, right? And this was something that I did last night, and it was pretty clear that this was entry, right? So was the 4 hour, I believe. It was the trend rate here, the top of this downtrend here. So fractally, I broke this down on a chart, and this was my target for theta last night, right? So this was an untested level after it was gained, and let's turn the magnet tool on. So this is a trade I took last night, right? As theta was dumping, I knew that would be where I would bounce off of, so I took that trade. So that's how I identified my trade target, right? Right here. And actually, this was this morning, not last night. My mistake. Maybe it was a different coin last night. I did this with another coin last night anyways. And I traded theta last night too. I wonder why did I buy? Because I know I bought right here. That's why I bought right here, because this is a move that I was in last night. Many of us were talking in Discord, and I was telling people I was entering this move at 11:55, and so this was kind of the thing right here, right? The start of this downtrend was here. So I knew that, oops, right there. So I knew that in this trade, if this level was held, so when this downtrend was created like this, right? If this level was starting to, oh, there we go, magnet tool being funny again, gets me every time. So I knew that that was the level, right? I knew that if this was going to hold as this came down, right, and I saw it bouncing like this, I knew that was, once it had broken down under and came back up, it was time to buy, right? So it comes here, and I said, okay, this is perfect entry, because look at, not only is this an accumulation zone for a local move, I can see that now this goes back to the idea of moving averages, where it is the idea of time versus a level, right? A set of data, a sample versus time that creates space. I know this space right here that's being created. So that space right there. So this squiggly line here, that space right there is this space right here that's created. And I know this is getting more and more and more condensed across all time frames as time goes on. I'm knowing that as price is going down and this space is being reduced, I know that there is going to be a larger amount of interest to buy that stock in the future. So when this happens here, the amount of space that was created here, right? This amount of space has then become into a squeeze point. So that's really the only thing that the moving average told me about this entire trade, is that I knew that this would go up to a certain point, right? And it wasn't moving average reversal. I just wanted to take exit on the test of the downtrend, which I did right there, right? I took exit somewhere in here, right? I took it a few sats lower because I didn't want to have it touch for 1 cent and then just dump down. So, and it was as simple as that. I knew that the moving average was starting to compress, right? Same with here, right? Same with all these time frames that happen. The idea that this is getting to be a shorter amount, right, was apparent on all time frames, right? Just like this. It was becoming, the space was becoming shorter, because if you were to take that idea of moving averages, look how big the space is here, right? There's going to be less interest when there's more space, because less of these things in the market happen, less of these triggers, less of the race happens, right? The race is happening here, right? The race is happening here. Less of things like the race happens, where you have indicators and people who are FOMOing and all these things in the market, right? Less of that is happening here, which is going to have less volume, which is going to have less buying pressure, which is going to have less of everything. There's too much space, right? So the whole idea of moving averages and what they can do for you is not a lot. And what they can do for you, though, is that they can measure points of interest, which is really the big takeaway, because believe it or not, as little as I use indicators, moving averages give me a lot of information, because if something is about to cross over, right? And if we were to go back to here, right? And we're on theta right now, and I am looking at a 15-minute chart, remove all drawing tools, and I go to a 15-minute chart, right? If this level is to be held here, so if that level is to be held there, I know that there is going to be interest created at this point. So that is important to know, because it will help dictate how far the move can go, because it will give you almost a future insight to what can this move potentially do, right? We know that if we held here, what can this move potentially do as the hours unfold, as it does this, as it does that, right? It's the idea that the space is being reduced by the average coming on top of the sample. So if you were to enter this trade here, right here, as it closes up and over it, that magnet tool, good old magnet tool. So if you were to take this level here and you were to enter this trade here, you know that in the future, what can happen? You can have an increased amount of interest, because if price is starting to accumulate up and you have an average coming down, this is going to be that area where people start buying. So you know that there can be potential for ignition on this move. And that's what it comes down to, is ignition, right? That's what it comes down to, is that how much interest can be created in a move? How much volume is there going to be, right? The same thing here, right? You're going to come down and this is going to come up, and that space is going to create that move. So really, again, the takeaway from moving averages is to help you understand that a moving average only creates an event. It can only create something where the race is happening, and it's not always a good thing, right? Like, you have to realize that the race can be the beginning of the race, it can be the end of the race, it can be the beginning of a dump, it can be the end of a dump. The race doesn't dictate what's happening in the move. The race dictates the interest. So the race, or the crossing of moving averages, is showing you an event that's about to occur. And I guess that's the best way to put it, is it's dictating an event, and it's showing an event that's about to occur. All right. So let's go over this list one more time. Make sure we covered everything. What is a moving average? Moving average is simply just the calculation of a sample number, your sample size or your sample data versus the time and the effect that those samples have against each other, which is the next point, the measurement of time and its effect. So what is that doing, right, in the space that gets created? And realizing that the larger the space is, right, so if you have moving averages and you have something that looks like this, right, you have something that looks like this, there is less space here, right? There is more space there, and then there is less space that's being created here. So the more that space is compacting on top of each other, the more interest, whether it be up or down, that is going to be created. And as space grows, right, you are going to have less interest on kind of these larger moves from what you can glean from the data of this line to this line, because the space is increasing. As it's compressing, that space is lessening, which means as that space lessens and it compresses, and these two levels, right, this orange level, or sorry, not orange, pink, and we're going to color it pink, this pink level and this level here, right, those two levels, space is being reduced. So something of interest is going to happen here, and that's really all you can glean off of it, is that idea that something will happen because it's creating interest in one way or another, right? So important to understand that. The mechanical, so, you know, kind of disembodying all these different systems, and you guys can probably understand and see why now. You know, I hate to say it, but there's so many trading systems and techniques out there, and people who are trading based on moving averages, where something like this equals 1 point and this equals 2 points because those crossed, and this equals 4 points because it happened after this event. And that's how these calculators work, right? Like that's how these moving average calculators work, and these different indicators that you guys use online, you know, different types of indicators on TradingView, where they call it like the God mode moving average indicator, where they do something like they mix, you know, volume weighted price and something like an indicator calculator based on point system, and they mix these things together to give the perfect signal, right? Like that's why indicators are useless, because they can't show you what's going on. All they can do is take data subsamples and give you like a point system, right? Like almost like I don't want to do the work, so I'm just going to use this calculator or this indicator, and then most of the time they fail because you don't really see what's going on in the move. So, you know, the idea of the mechanical trading, where you have a set of criteria based on things like moving averages based on data, mechanical trading is highly flawed. And just even in the baseline thinking of why it could work and how it could work is you know, also highly flawed. So the mechanical trading strategies and how they don't work, and really what can you glean, and this becomes the most important part of the entire moving averages lesson, is the race, understanding the race that happens, the race of people starting to enter a move, and where did you enter in that race, right? Let's go back to the chart here, right? The race, right? If you see that, phone is ringing, sorry about that. If you see that this was probably right here, it looks like price came down, came up, came down. You know, if we break this down to the hourly, where does that uptrend start? You have an uptrend that starts here. So that's the level right there of the uptrend, right? So if this price continues to hold in the future, right, comes, it holds, it holds, it holds. Where did you enter on this race, right? Where did you enter? Did you enter based on proper technical analysis knowledge? So you're entering somewhere in an accumulation zone, because that's what TA is, right? You're entering in the accumulation zone, which is clearly right here. And then you have your final downtrend, and to just show you why this thing moves up, you have your final downtrend here. So if you close over top of this downtrend, which you come up and you test it and you come back down and you break right through it, if you close over top of this, you're going to start closing over other trends, right? Because that's what trend reversal is when you close over other trends. So when you're entering the race, did you enter based on proper TA, or did you enter up here based on MA information, or did you enter up here based on uh, an indicator or a calculator signal. Did you enter here because you FOMO'd in, right? It becomes where did you enter? It becomes where in the race did you enter? And if you entered here, how soon can you get out of this thing, right? Like this was a 1 hour move, which is probably just like a big, pretty, pretty big crazy. My camera's out of focus. Ah, that's not cool. Wonder if I can get it back in focus. There we go. That's because I'm recording during the day. Usually I record during the night. This is only a 15-minute move, and this whole entire ramp up here only lasted half an hour. So depending on where you entered, did you even have time to see where proper exit would be? Or did you do something like wait for the retracement, enter here, thinking this thing was going to go higher, and then it came and you had to exit here and you lost money, right? So it's just it becomes the golden nugget is, where did you enter in the race, and understanding why moving averages work the way they do and how they affect the industry and how they impact things. You can clearly see that if you are ever using moving average strategy or any kind of mechanical trading systems, you're just entering the race late and you're increasing your risk, right? So it's pretty much as simple as that. And really the information to glean off that, and the most important thing again is understanding the concept of the race and what happens before the race starts. What are the events of the race, and both sides of the race? So what happens when it starts and what happens when it ends, right? So just like you'll see it all the time when, and this is a good point to make out. You'll see it all the time when you have these moving averages cross, and then you go to something like the monthly. And I don't think this coin would have done it. This moved for a different reason. Maybe if we go to the weekly, it might have it. People will say that, oh, well, we should sell here because it's going to touch this weekly moving average and that's the level. Moving averages aren't levels. They're soft levels. They just give you information. They're not even real levels. They are not something that will show you a move, right? And you would have had people exiting here at 1600 and maybe they're moving, their strategy said that they should buy here at 1500 and then exit at 1600. And meanwhile, they could have entered at 1200 and left at 3700, right? And this was just the end. This ended up just being, right? If you take a look at these downtrends that were created, right? Here's a downtrend right here. It was already tested right here. So this is already a tested level. So on a weekly chart, right? This was already a tested level. What's the next level? What's the next untested downtrend? Right here. So that was tested. What's the next one? Right here, right? So you can see they all end up becoming tested levels at some point or another. And on the 15-minute time frame, I wonder if we were to break this down and take a look. So that one candle actually wicked both levels there, and that's why it happens, because this candle closes over top of this trend here. I would suspect that had this wick come up and then down and closed underneath this starting of this weekly downtrend, you probably wouldn't have had this reach up to here. But I'm assuming that's why, because it was such a strong move that it just tested the next trend. So yeah, hopefully that insight gives you guys the realization of how moving averages are useful. And going back to this, so both events of the race and floating, and what does floating mean? And this kind of just ties into moving averages. And when you gain a free level, you're gaining a free level of support. When you float through something, it's for the same reasons trend breaks when they float through. When we, going back to the beginner's knowledge, touching back to trend lines and wedges, when you float through a wedge or when you float through a trend line, it's like gaining free support. All of a sudden you have this peak of interest, right? So you have this peak of interest where, and I'm going to go back again, right? Kind of dragging this thing out, but that's okay. I want to hammer this point home. You have something like this where you float through a level, right? And, this is just the first thing that was on the screen. Let's turn the moving averages off here. Oops. They're all back on. Okay. As good as a magnet tool. So you have this thing here where you float through a level and you start to move up, right? So it's the same thing with moving averages. When you float through a moving average, it's like gaining free support. You have a spur. If there is zero volume here, right? If there is no volume and people are just accumulating and you end up breaking trend, people are going to start buying because it's like a free level of support. It's like free rolling, right? It's like getting $100 free credit at a casino to play on a blackjack table. Why wouldn't you use it, right? It's the same thing. You're just gaining free support. You didn't have to do anything to break it other than hold price and accumulate. So all you had to do was stop the price from moving down, which happens in every stock. So you end up floating the level. And the same thing happens with moving averages, as you saw on BRD coin. But BRD, Breadcoin, it wasn't the moving average that caused the move, right? It was the idea, and it was the knowledge, knowing that if a weekly level is going to float through, you actually saw it floating through the level and taking huge leaps up on the weekly level, because you floated through a weekly level, which is going to create the most amount of interest that coin can have. So it takes a large move up. So same idea with floating through moving averages and things like that, right? When you float through a moving average, the difference is that you have just floated through a moving average. You are going to create interest, right? It's the same thing. So floating in general as an idea and a theory. And then ignition, where one level, 15-minute charts ignite into an hourly chart, which ignites into a 4-hour, which ignites into a 12-hour. So it's the chain of events that happen where one level is causing another level to move in such a manner that's going to cause another level to be touched and tested, and therefore so on and so on. And it's not to say that those are buy points, but those are points of interest. So if you were to only float, or not float, if you were to only ignite through a 15-minute level, you'll have only a certain amount of interest. But then if you're floating through two 15-minute levels, you're going to have more interest. And then if those two 15-minute levels are going to pull you through an hourly level, you're going to have even more interest. So that's ignition, when you have levels pulling levels through levels, right? And that's sometimes why bigger moves happen, right? So the idea of ignition is to understand how much interest and how much attention a move will get. So that does it for moving averages. I hope you guys enjoyed this, and we'll see you on the next one. Take care. Bye.